Good morning and welcome back to the channel. This video is not financial advice. I'm not a financial advisor. Do your own research and make your own decisions. Okay, so I have an important video. I want to go over the debt to GDP. I want to go over the national debt, the interest that's owed on the debt, and the Fed funds rate. Because once I started digging into these numbers, it looks like there's only really one plausible outcome with this whole situation. And when you're trying to play out possible scenario, what they want people to think is that there's just a million different possible outcomes here, and that we should just curl up in the fetal position and be very afraid. But I think I know why the billionaire class is not nearly as concerned as what you would expect them to be, given the numbers that I'm about to go over. Because I think that it's a foregone conclusion that they're going to reverse course and ultimately print into infinity until the dollar absolutely collapses, and then they're going to transition us to the new system. That's what it looks like. And if you can come up with a alternative position given these numbers, please type it out in the comment section below. See, I'm not being sarcastic when I say that. I'm being dead serious, because these are important conversations. When I go over these numbers, you're going to wonder why the numbers that I'm going over are not reiterated on a daily basis, because the numbers paint a very clear picture of what's coming, unless they decide to change what they have been doing for 40 years. 40 years of doing one specific or having the system structured this way. The system has been structured this way for 40 years. And to assume that they're going to stop that now, it's hard to make sense of that position. So this is important for the assets that we're holding, and for the next 6 to 12 months, when you're just looking at when you're trying to make decisions about what you should do. It's important to understand where we are and what's potentially coming down the road. Well, you can't understand what's coming down the road if you don't know the possible likely outcomes given what's happening right now, right? So that's what I want to go over. Now, there's two graphs I want you to look up. One is the Fed funds rate, which I've already shown in my community tab. It's been going down for 40 years. Now, you could draw a line right through the middle of the trend, and it would look something like this. Now, the other graph I want you to look at is the national debt, or debt to GDP, because they follow very similar trends. Okay, so we have interest rates going down for 40 years. We have debt and debt to GDP going up for 40 years. And remember, this all started right in the 80s, after we were taken off of the gold standard in the 70s. Guys, the system is just structured this way. And I finally understand what so many people were saying, but they never broke the numbers down to where the normal everyday listener could make sense of what they're saying. So that's what I want to do in this video. So we have 30 trillion in debt, okay? 30 trillion. So we have to pay interest on that debt. Now, we average around $500 billion of interest on that debt annually. That's important. Remember certain numbers. 30 trillion is an important number to remember, but also remember 500 billion, because that's the average that we pay on the debt. All right. Now, how much money does the U.S. government bring in tax revenue every year? Roughly 4 trillion. Okay, so GDP is roughly 22 trillion. Obviously, these are going to fluctuate a lot over this year and over the last few years because of everything that's happened with the economy. But let's just say 22 trillion. That's U.S. GDP. Now, of that, the government takes 4% roughly, and not 4%, 4 trillion, which comes out to be about 18%. Okay, so that's the amount of money that the U.S. government has to fund government, is 4 trillion, give or take. The issue is that debt to GDP has been climbing for 40 years. The same way interest rates have been going down, debt to GDP has been going up. We're now over 100%, and we got up to, please look at this graph. I mean seriously, that's what you're going to see. You're going to see it just going straight up for the last 40 years. So right now it's over 100%. So even though we acknowledge that we're only bringing in, the U.S. government only has 4 trillion in tax revenue, we openly acknowledge that we're spending more than 4 trillion. All right, so off the jump, we're openly saying we're going to have to print more just to fund government, because we're only bringing in X. but our expenses are X plus whatever. All right. So off the jump, they're acknowledging that despite the massive debt bubble that we're in, they're going to continue to spend more from the government level. They're going to continue to add new employees. They're going to continue to put in new bureaucracies. And they're only bringing in this, but they're spending this. All right, that's important to know. Now, why does it not make sense for them to raise interest rates much higher? Well, that's what we're going to be going over here. And see, this is the big bluff. This is the big look over here. This is the biggest scam in world history. It really is. It really is. Okay, so 30 trillion in debt. They have to pay interest on that debt. We've been averaging 500 billion annually. Now, last year, per CNBC, the average interest on the debt was 1.5%. All right, so that was for 2021. The average interest on the debt was 1.5%. All right, now let's just say that they were to have to pay a 3% average interest rate on the debt. That means that we would go from 500 billion roughly to 900 billion, okay? So we would go to $900 billion in interest on the debt when we're only bringing in 4 trillion. Okay, they have to pay that interest. Where do they get the money to pay that interest? The tax revenue that they bring in. Okay, but we're already, debt to GDP is already over 100%. So if they're going to raise interest rates, they're going to have to pay more interest on the debt. And so debt to GDP is just going to grow because the money has to come from somewhere. And unless they're going to cut 20, 30, 40% of government jobs and bureaucracies, then they have no other way to produce the money other than just to print it. Let's just say debt to GDP is roughly 125%. It's right in that range, okay? After the 08-09 housing crash and the big stimulus plan, debt to GDP went up over 100%, and that's where it stayed. All right, now it jumped up to about 140 during the pandemic and the mass money printing. But that's just where it stands right now. Okay, it used to be 30, 40%. And then just over the years, it's just continually climbed as interest rates have, and you would expect to see that in a system like this. You would expect to see those two things inversely correlated. I don't know if that's the right term, but that's what it, one's going up, one's going down. All right, so at a 3% interest rate, they would have to pay 900 billion on the debt. At a 4% interest rate, they would have to pay 1.2 trillion on the debt. They're only bringing in 4 trillion. And guys, we're not talking about paying off the debt. We're just talking about paying interest on the debt. That's it. Okay? So at a 4% interest rate, they would have to pay 1.2 trillion on their debt annually. At a 5% interest rate, they would have to pay 1.5 trillion annually on the debt, just for interest. That's roughly 40% of the money that they're bringing in from tax revenue. Think about that. Now, there's another dynamic here, because let's just say they do raise interest rates to 5%, and they do have to pay 1.5 trillion interest on the debt, which is 40%, which is almost half of the total amount of money they're bringing in tax revenue, which is 4 trillion. All right. But the issue is, if they raise rates to 5%, think about the amount of bankruptcies that are going to happen with numerous different corporations. Now, at some point, some corporations are going to go bust. I think that's just a part of the plan. Some are not designed to be here in 5 years. But if they raise interest rates like that, let's just say they just continually raise interest rates throughout the next 18 months. Okay, well, think about all the companies that are going to go bankrupt. Think about all the jobs that are going to be lost. Jay Powell even acknowledged that unemployment rate would probably go up, right? So less jobs, less people working, less companies in business because they went bust because interest rates were going up. That means the government's bringing in even less tax revenue now. Let's just say it was 4 trillion, because as GDP comes down, unless they're going to raise the percentage that they tax, then so is the tax revenue that they're going to be bringing in. So it was 4 trillion. If they raise interest rates to 5% or whatever it may be, if that's the interest they have to pay, then that 4 trillion that they're bringing in is likely going to go down as well. So, but they're having to pay exponentially more interest. So they get hit twice. Their overall tax revenue will likely come down because of the loss of jobs in the economy, but the amount of interest that they're having to pay goes up exponentially. So they're the least incentivized people in the world to see interest rates go up. There's nobody that is less incentivized for interest rates to go up than the US government and for other governments that are heavily, heavily, heavily indebted. And I understand that a lot of people, they want to make the debt cheap, and everybody will say certain things. But I've never heard somebody break down the numbers as to why that is the case, right? Understand this is a living, breathing organism, okay? This is the way the system was designed to do this, to have interest rates gradually go down to zero and to have debt gradually go up to infinity, all right? Okay, so let's just play out the scenarios. Does it make sense for them to raise interest rates? They're going to destroy a lot of businesses, meaning the tax revenue, the dollars that they're going to get in tax revenue is going to go down. And on top of that, they're going to have to spend exponentially more in interest. Right now, debt is at, their tax revenue is at $4 trillion, and they're paying roughly $500 billion in interest, okay? So, but if interest rates go up, they're paying exponentially more in interest, but yet tax revenue is going down. So they're the least incentivized people in the world to raise interest rates. And that's probably why it's happened so slow. And that's probably why, if you look at the interest rates over the last 40 years, they've been going straight down. All right. Important things to remember here. So that's the route that we just went through the scenario. If they really are serious and they're going to raise interest rates, we went over how that would affect the U.S. government. All right. Ultimately, it would probably lead to the government going bankrupt and defaulting on their debt and collapsing. So what's the other alternative? Well, they can drop interest rates and they can continue to print. And that's what it looks like they're going to do. Because for you to believe that they're going to do something other than that, you would have to make sense of all of a sudden after 40 years, numerous different 40-year trends would have to be broken. And on top of that, you would have to acknowledge that they're going to do something. Let's just say there's two avenues they could take, more or less, right? There's kind of some gray area there, but for the most part, there's two different avenues. They could aggressively raise rates, or even just continue to raise rates and deal with the ultimate consequences of that. Or they could reverse course and just continue to print and inflate most of the debt away and crash the dollar, transition to the new system. And they've been devaluing the currency for 40 years. Why are they going to stop now? What incentive is there? What incentives are there for them to stop? Because in both scenarios, you end up with a general population that's more or less broke. They can achieve that goal either way. Either way, they can achieve that goal. If they completely crash everything and raise interest rates and just destroy the stock market and just destroy everything, well, normal everyday people are going to be broke. If they continue to print and inflation continues to go up, normal everyday people are going to be broke. But it's going to affect them, okay, so it's going to affect normal people relatively the same outcome, but it's going to affect the elites drastically different if they continue to print and they continue to blow this bubble, or if they aggressively raise interest rates and they just start to bring everything down. Okay. All right. Now, an important thing to remember here. UBI has not been rolled out. Stimulus checks have not been rolled out. How do you think this is going to play out? Do you think that they're just, people are just going to everybody's just going to go bankrupt and, they're going to not do anything? We've already known that UBI is part of the bigger picture. That's something that's been thrown out numerous different times. That's something that billionaire Jack Dorsey's been working on. That's something that many politicians and many elites have talked about being a part of the future, is universal basic income. So if that's a part of the bigger picture, then at some point in time that has to start happening. And if you're looking at what's happening right now with household debt absolutely skyrocketing, with credit card debt absolutely skyrocketing, and with real wages going down against inflation, it's only a matter of time. It's only a matter of time. But for you to believe that they're going to do anything other than continue to print and inflate the dollar and ultimately tank the dollar, For you to believe that, you have to make sense of why they're going to change behavior after 40 years. The fact that it's irresponsible monetary policy and it's led to previous crashes, that's not stopping them now at all. And it's important to understand that if you go back 40 years over these different graphs, over interest rates going down and debt to GDP going up, it's always an event, right? The dot-com crash, the housing market crash, the pandemic crash. It's always something that causes interest rates to collapse and causes debt to GDP to take off. Every single time. Go back throughout history. Go look at the graphs and look at where they align in the time frame and what other things were going on at that point in time. This is how the system is designed to work. This is how it is designed to work to its ultimate demise, okay? It runs like this until it's done, all right? Interest rates continue to go down, sometimes even into negative territory, and debt to GDP continues to go up to the point to where it's, even in Japan, well over 200%. Okay. Also, this does not include the 30 trillion in debt that we have does not include unfunded liabilities, Social Security, Medicare, Medicaid. There's no evidence that they're going to stop doing this. There's none. There is overwhelming evidence that they're going to continue to do this, and there's no evidence that they're going to stop. This isn't meant for them to stop printing. Okay, the debt's never meant to be paid back. Okay, when I was going over the interest they have to pay on the debt, again, that's not paying off the debt. That's just paying interest on the debt. That's it. And as it currently stands, we're bringing in U.S. government bringing in X amount of dollars, but we're openly acknowledging we're spending more than we're bringing in, on top of a $30 trillion debt bubble, and even more when you take into consideration unfunded liabilities. So what's in their best interest? That's the thing to ask, not what's in our best interest, because what's our best interest doesn't matter. And to be honest with you, either way they take this, whether they take this to continue to print and hyperinflate the dollar, or they decide to aggressively raise interest rates and collapse everything, the end result for the normal everyday person is going to be the same. We're going to be broke. Not us, for the most part, but I mean, as long as something insane doesn't happen, but everybody else will be broke. Almost all normal people will be broke. So it's going to affect normal people the same way, but it's going to affect the elites very differently. There's one that would be more advantageous for them, and in my personal opinion, is to continue to inflate. These are the people that own all the assets, guys. I mean, think about this. There's X amount of gold. There's X amount of silver. There's X amount of Bitcoin. There's X amount of Stellar, of ICP, of Algorand, right? There's X amount of houses, there's X amount of farmland, right? So there's a set number of a lot of these different things, but they might have an inflation rate of 1, 2, 3, 4, 5%, whatever it may be, depending on the asset that you're talking about. But there's a number of those, okay? And so that's where we stand right now with all these different assets. But if the debt has if there's no other options but for them to continue to produce more dollars and to put more dollars into circulation to keep this thing alive, which they would have to do given the numbers that I just laid out, if the only option is to continue to create more dollars, there's nowhere to go for asset prices but up. Now, in the intermediate period, can they do this with markets to shake people out and to unwind a lot of leverage? 100%. But big picture, the only rational conclusion here is that they just continue to create more dollars. And again, for you to assume that they're going to do something else is for you to assume that 40-year trend lines are going to break, that they're going to all of a sudden change behavior after 40 years of doing the exact same thing. All right. If they let companies go bankrupt, again, back to my point, they bring in $4 trillion in tax revenue. All right. Right now, they're spending roughly $500 billion in interest, right? And they're already acknowledging they're spending more than $4 trillion, but let's just stick with this. They're bringing in $4 trillion. They're already spending $500 billion in tax revenue. If they raise interest rates, the amount of tax revenue that they're going to get is going to be less because companies are going to go bankrupt. There's going to be less jobs. There's going to be less people paying taxes, all right? So that $4 trillion is going to come down. Right? But the interest that they have to pay on the debt, because the debt's not going to change. They're not actually paying off the debt. The debt's just growing. So the interest that they have to pay on the debt is going to go up. So what makes the most sense for them, right? The most sense for them is to have interest rates as low as possible, because the more that they do this, okay, the less tax revenue they're bringing in, the more interest that they're having to pay. And so the debt to GDP is just going to go straight like that for them to be able to finance all of this. There's no way out of this. There's no way out of this. There's really not, other than blow everything up. And billionaires look too calm, and I think that this is why. I think that they know that the only plausible outcome here is to print. And while it seems right now like everything's going to crash, and guys, listen, a financial institution could blow up next week. Kevin O'Leary's even starting to float that out there. He says we need a financial institution to blow up, and he was just like, but I think that there's, he said there's people that are offsides, and we're going to wake up one day and find out that they went bust. And he said, and that will be the event that we need to really mark the transition to a uptrend in markets. But whether or not that happens, billionaires are just too calm right now, given the economic conditions that we're in. And think about the numbers that I just went over, guys. Now, when you hear those numbers, think about listening to these bankers that come out and they give press conferences and they talk about how everything's okay, right? We're all right. We got some inflation, but we're working on this. We got some supply chain issues. It's everything is done. It's finished. It's over. This is the biggest scam in the world. Okay, only to be outdone by the new scam, which they're currently implementing. Not that I think, it's relative. Cryptos, I think, is a better system than the old system. But the way that they're rolling it out and that they're implementing it, and the mass propaganda and psychological warfare that's wrapped around it is, it's outdoing the current scam, which is the one that I'm going over right now. So I don't think there's any realistic options other than them continuing to print. It's in their best interest to continue to print. All right? And now, from right now today, Wednesday, May, whatever today is, until, let's just say, assume they decide to shift course here. So from now until then, the intermediate period, guys, we could dip lower. There could be more crazy things that come up. Here's the thing, guys. I think that another big catalyst is going to have to happen, because they're going to have to need a reason to reverse course. And whether that be a financial institution blowing up, whether that be the war escalating, whether that be a number of different catalysts that could happen, there's going to have to be something that happens that reverses course. Now, when that something happens, markets may react how they're going to react. But the ultimate outcome here, there's only one realistic outcome, and that is that interest rates ultimately go back down, debt to GDP continues to go up, debt continues to go up. That's the way the system was created. I finally understand what Greg has been saying for the last few months. I understood it in a general sense, but I didn't break down the numbers well enough to understand that there's not really but one plausible outcome here. Yes, they could raise interest rates, but we just went over that scenario. It doesn't make a lot of sense for them to do that. And I think that that's why interest rates are still, and guys, listen, here's the thing. Even if they raise interest rates, and let's just say interest rates get up, they're paying that 5%. Let's just say, speaking hypothetically, that were to happen. Okay, that's still not going to stop inflation. You're still, even if you have a 5% interest rate, interest rates are still aren't high enough to stop inflation, because inflation is probably at least 15%. So you're still talking about negative real rates. And again, there's finite amount of assets, which again, some have, inflation levels of small percentages, but there's X amount of assets, but yet the dollars in circulation are just going to have to continue to grow. And the more that they print, the more that they have to print. So it only just compounds year after year, decade after decade. Okay, that's my piece. Let me know your thoughts in the comment section below. If you think that there's another realistic outcome here other than them continuing to print, let me know why in the comment section below, and let me know your thoughts. That's all I have for this video. This is not financial advice. Do your own research, make your own decisions. If I got anything wrong, let me know in the comment section below. that's that. Take care. Have a good day. I'll see you in the next video.